to the latest Wescott webinar series on the economic and market outlook. I'm Mark McCarron, Wescott's Chief Investment Officer. And in today's update, in fact, it's going to be the last one of 2020. We're going to take you through the markets as of December 18th, take a quick look back as to what's gone on in the markets this year. And then the theme really is from a very difficult year, despair to repair, which we hope is the theme of 2021 as the market repairs, as the economy is repaired and reopens, and some of the things that we're expecting to see going forward. And as usual, we'll end with our 2021 outlook and what to expect in the new year. So as we have done throughout this year, really since the pandemic started, is to give a webinar market update. And in this particular update, it's really amazing to look back as we come to the end of 2020, which is a year that was defined by the shock of the COVID-19 pandemic. What's really heartening is that those at most risk are beginning to actually receive the vaccines that were developed in what was record time. And that's fantastic news and unexpected, to be honest. And really this good news on the vaccine front comes really as, unfortunately, the virus is still with us. Confirmed cases around the world have started to rise again in November and in December. Which, to be honest, has delayed, obviously, a full recovery. But what was pretty amazing this past year was the decisive action taken first by the U.S. Federal Reserve to lower rates and support markets through bond purchases. And the congressional response, the initial response by Congress in March to provide businesses and individuals either direct payments or support to make sure they can get through a period of uncertainty. And that provided investors the confidence that really did support the markets. So really, as we look at it today, despite rising daily cases and a slowing recovery, global stock markets continue to rise. And that's because their expectations are and the hopes are for an additional fiscal stimulus, and ultimately for a globally accessible vaccine, which has already started to come through. So how does this affect the markets and what's gone on this past year? We've shown this version of this chart throughout this year in different ways, different forms. But today we're showing the performance of three basic US indexes from the start of the year to really December 17th, nearly the end of the year. And the COVID-19 pandemic and its realization at the beginning of this year was an exogenous shock to the global economy. So what that means is it comes from nowhere, really. It's not an internally developed driver, but an external shock to the system. And that resulted in a very deep, but extremely temporary market decline. As you can see in the graph on the right, not only that, but it actually resulted in a very quick but extremely narrow market recovery. We've talked a lot about this throughout the years. So the orange line is the growth index, which incorporates all of the technology and healthcare stocks that are in favor. And the blue line is the value index, which is really made up of financials, energy, and other economically sensitive sectors, such as transportation. Clearly, the impact of the COVID-19 pandemic was a shock worse on the value side than it was on the growth side. In fact, it supported certain technologies that enabled us all to work from home and school from home and really do what we can virtually. One of the things we wanted to highlight, though, is actions taken in the Wescott portfolios back really throughout 2019 and early 2020 were designed to increase the quality of portfolios. And that did provide more stability and resilience in these volatile markets. And as we stand here today and look toward 2021, we talked a lot about this too, but the pandemic trade, which favored growth stocks in 2020, which is indicated here by this orange line, we think will shift over to more of a reopening trade, which is really when the vaccine becomes widely available, we go back to our normal everyday lives as normal as we can. That will likely favor value stocks, those stocks that were under pressure for most of this year. And you can actually see at the end of this year, just in the last couple of months, that blue line coming back not only to zero where it started the year, but a strong improvement over the last several months. And that's because anticipation of a vaccine and return to normal is coming through. So that's a look back. It's really important to look at a historical perspective. So very quickly, we want to talk about the dominance of growth stocks we see in 2020 is not just a one-off trend. In fact, it continues a trend that's been in place since 2007, which is now 13 years ago. And so what we have on the right-hand side is a table that shows very long-term annualized returns for indexes that represent value and growth. First on the small cap side, then on the large cap side. So this data comes from bank credit analysts, but they've actually got it from Fama and French, which are two academics whose research drive a lot of research in the industry, but also Dimensional Fund Advisors and their approach, which is a firm that we use quite extensively throughout client portfolios. And there's a lot of numbers here, but what we're showing is the long-term return premium associated with value stocks is shown here. Since 1926, value stocks have outperformed growth stocks by 5.1%. Even since 1970, we've seen value stocks outperform growth stocks by 6.3%, but since 2007, it's been flipped. A 3.6% return for value has really underperformed the 8.8% annualized return for growth by 5.1%. That's on the small cap side. If you look also at the large cap, value versus growth, the difference is even wider. And that impact has even expanded more dramatically in 2020. So while growth stocks and growth company earnings are in fact growing faster than earnings for value stocks, the price you have to pay for those earnings has also gone up quite a lot for growth stocks. And what we see is value companies tend to perform well in periods of improving global growth, falling US currency, falling US dollar, and rising interest rates. And again, we're beginning to see evidence of all three of those things as we end 2020. So the idea here is that we've come from a very difficult year. 2020 was an awful year in many ways. And the despair that many felt, whether it's in their personal lives, whether it's in their businesses, or even in the market volatility, we're hoping for repair in 2021, and we're beginning to see evidence of that as well. So what are we seeing? So as anticipated, what's the trigger for this? With the positive news on the vaccine front, economically sensitive value stocks and the managers that follow that style began to recover some of lost ground. And that's on the hopes that we'll get back to normal soon. This chart we've updated on a regular basis, but this is as of December 17th and reflects quarter to date so far. The fact that the equal weighted index for the S&P at 17% is outpacing the S&P 500, which is market cap weighted, just suggests that we're getting a broader participation from all companies in the market, not just the top 10 companies. And in fact, we're seeing a pickup in small companies, both value and growth, but particularly on the value side as some of these economically sensitive sectors rebound. And some of those sectors include financials, industrials, and energy. And it's really important to note that Wescott client portfolios have a mix of both. And that combination of things ensures that as quickly as we've seen this shift in market leadership. We're already there, we're already positioned, and client portfolios are benefiting from that change already. So where does that leave us for 2021? Our outlook remains positive and hopeful, and we expect continued support from the Federal Reserve, who's going to keep interest rates quite low. So what we're showing on this chart is where interest rates were way back in 2007, again 13 years ago, up to about 4.5%. But since then, we've been really living in a world of very low, almost zero interest rate policy, only up until about 2007 and 2017, 2018, where the Fed started to raise interest rates a little bit, all the way up until the end of 2019, and then quickly dropped it to zero again in the midst of the pandemic. This has supported stock markets generally, and also supported growth companies, really because you're able to justify paying a higher price the lower interest rates that you have. And while we do expect the markets to recover and continue to grow next year, we do anticipate that with the economic growth rebound, both here and abroad, and the valuations that are much more attractive in certain areas of the market, and again, a weaker US dollar, we expect the recovery to be driven by the cyclical sectors going forward. And again, we're positioned for that today in portfolios. So with that, just a quick reminder, we've come from a pandemic-driven market, one that's been defined by uncertainty and a subsequent flight to safety and quality, to what we hope to be a broadening of the market as the economy reopens and return to normal. So we've already seen evidence of that. We're ending 2020 on a good note, on a positive note. The successful development of the vaccine is really the key, and the start of the global distribution and the administration of that vaccine really does bode well for a return to normal. The fact is that many of the areas of the market that are under pressure in 2020 will get relief almost immediately as we get back to normal. That's travel, airlines, hotels, restaurants, other things. And as a reminder, our portfolio strategy continues to emphasize all areas of the world by region, by style, and by company size. And that's really to make sure we still meet the objectives of our clients, regardless of what sector or what area of the market is driving markets higher. And continued reminder, our positioning going forward is supported by attractive relative valuations and sound fundamentals. So with all of that, we thank you again for joining us. We thank you for your continued trust, particularly over 2020, which is a very difficult time in many ways. We wish you all very happy holidays and a very happy and healthy new year.